Everyone says index funds are safe, diversified, the boring, smart choice your dad told you to make. But here's the thing, 32% of your diversified S&P 500 is just 7 tech stocks. 7. Apple, Microsoft, Nvidia, Tesla, Amazon, Meta, Google, and they're trading at .com bubble valuations. Picture this, you think you're being responsible, buying VOO like Warren Buffett told you to, but you're actually making a leveraged bet on the AI narrative without even knowing it. I've been there. I thought I was diversified too, until I actually looked at what I owned. And what I found? It's happened before. The Nifty 50 in the 1970s. Same concentration, same can't-lose mentality. It crashed 80%. In the next few minutes, I'm going to show you the warning signs flashing right now and what you can actually do about it before history repeats itself. Act 1. The lie. It's 2025. You're being responsible. You bought VOO because Warren Buffett told you to, and when a 94-year-old billionaire who eats McDonald's for breakfast gives financial advice, you listen. You feel diversified across 500 companies. You're basically eating your vegetables. But here's what nobody tells you. The Magnificent Seven, Apple, Microsoft, Nvidia, Tesla, Amazon, Meta, and Google make up 32% of your diversified index fund. That means for every dollar you invest, 32 cents goes to just 7 companies. And those companies aren't trading at reasonable prices. Nvidia's at 48 times earnings when the S&P average is 22. And Tesla? 291 times earnings. Let me put that in perspective. If you bought Tesla today and it stopped growing forever, it would take 291 years to earn back what you paid. You know what happened 291 years ago? Benjamin Franklin was 28 years old. Tesla is priced like it's going to outlive the Constitution. You're not diversified. You're betting Elon's Twitter habits don't tank your retirement. Act 2. Nifty 50. We've seen this movie before. Rewind to 1972. America's riding high. Bell-bottoms are fashionable. And Wall Street invents one-decision stocks, the Nifty 50. Buy the best companies like Coca-Cola, IBM, Polaroid, McDonald's, and never sell. They were so dominant, you only had to make one decision: buy. Sound familiar? Investors bid them up to insane valuations. Polaroid traded at 95 times earnings for a camera company whose entire business model would be obsolete in 20 years. McDonald's, a company that sells hamburgers, was at 60 to 70 times earnings. Not AI hamburgers, just hamburgers. The average Nifty 50 PE was 42. And at their peak, the Nifty 50 made up 45% of the entire stock market. Right now, the Magnificent Seven make up 32%. We're sprinting toward 45% like we're late for a financial crisis. And everyone's telling themselves the same story. These companies are different. This time, it's different. Those are the 4 most expensive words in investing. Act 3. The crash. So what happened to the Nifty 50? They did not grow forever. In 1973, reality showed up. Oil prices quadrupled. Inflation hit 11%. The market crashed 50%. And the Nifty 50 obliterated. Coca-Cola fell 60%. McDonald's fell 70%. Polaroid, the Tesla of its day, fell 91%. If you had $100,000 in Polaroid, you now had $9,000. And these weren't bad companies. Coca-Cola's still around. They were just overvalued. Investors paid too much. And when reality caught up, the price corrected violently. You know how long it took to break even? 8 years. 8 years of checking your portfolio and watching it do nothing. 8 years of avoiding eye contact at dinner parties when someone asks about your investments. That's the cost of buying overvalued stocks. You don't just lose money, you lose time. So what does this mean for you? 2 warning signs are flashing right now. Warning sign number 1. Valuations that require miracles. Tesla at 291 times earnings is more expensive than Cisco at the peak of the dot-com bubble. 200 times. Cisco had a monopoly on internet infrastructure. Tesla makes cars that sometimes catch on fire. For Tesla to justify its price, It needs to grow earnings 20 to 30% per year for a decade while competing with every car company on Earth. The math only works if everything goes perfect. And in investing, everything never goes perfect. Warning sign number 2. Insiders are selling. The people running these companies, the CEOs who know what's happening, are dumping shares at record levels. You can track this yourself on openinsider.com. If the CEO's selling millions, maybe you should pay attention. What to do? So what do you do? Don't panic, but do understand what you own. If you're 100% in VOO, 32% of your portfolio is 7 tech stocks. That's not diversification. That's risk dressed up as safety. 3 options to consider. 1. RSP. Equal weight S&P 500. Actual diversification across all 500 companies. 2. Add boring sectors. Utilities, healthcare, consumer staples. Not sexy, but they don't crater when AI hype dies. 3. Look outside the US. European stocks trade at 14 times earnings versus 22 times for the S&P stock, believing index funds are automatically safe. They're only as safe as what's inside them. And right now, they're concentrated in expensive tech stocks priced like they'll grow forever. History says they won't. I'm not trying to scare you. I'm trying to protect you. I've been the guy who thought he was diversified and wasn't. The index fund strategy works when the index isn't concentrated in 7 companies trading at bubble valuations. But right now, 32% of the S&P is 7 stocks priced like they'll grow forever. History says they won't. The last time this happened, people lost 60 to 80% and waited 8 years to break even. Don't be that person. Know what you own. Next video, I'm showing the 3 metrics that tell us exactly when this bubble pops. Comment below, what % of your portfolio is in index funds? If this made you rethink anything, hit subscribe. This is stuff nobody else talks about. See you in the next one.